The Bank of England just released its December 2025 financial stability report, and buried beneath the cautious, bureaucratic language is a warning that should terrify you. Risks to financial stability have increased this year. When the most conservative, measured, banker-like institution in Britain says risks are rising, it's not a casual observation, it's a red flag. I've gone through the full report, connecting what the bank says publicly with what it's clearly worried about behind closed doors. And here's my conclusion. We're no longer talking about a potential crash, we're talking about timing. The Bank of England is essentially telling us it will happen, they just won't say when. Let's break down what's really going on, and trust me, it's worse than the headlines suggest. First, the elephant in the room. Equity valuations. In the US, stocks are approaching their most stretched levels since the dot-com bubble. In the UK, valuations are near their highest since the 2008 financial crisis. At the center of this storm is artificial intelligence. The AI sector has become what the bank calls a hotspot. The governor noted that debt financing is rapidly increasing as AI firms seek massive infrastructure investment. Industry estimates suggest that over the next 5 years, AI infrastructure spending could exceed $5 trillion. That's trillion with a T. And roughly half of that will be financed through debt, not operating profits. Historically, tech giants funded growth from cash flows, real profits, real money. But the scale of AI investment is so enormous that even the biggest players are turning to debt markets. The bank has already spotted warning signs. Credit default swaps for heavily indebted AI firms are showing stress, and the market is beginning to price in risks that weren't visible a year ago. Meanwhile, market concentration is reaching dangerous levels. A handful of mega-cap tech stocks dominate indices. The bank warns that this makes equity markets fragile. If just 5 or 6 stocks falter, the entire market could crash. Sound familiar? It should. In 1999, everyone knew the internet would change the world, but valuations were absurd. Companies with no revenue traded at billions in market cap. When the bubble burst, the internet survived, but overpriced stocks didn't. AI might transform the world too, but current valuations are far from guaranteed returns. The bank is clear. Deeper links between AI firms and credit markets mean that if asset prices correct sharply, losses on lending could significantly threaten financial stability. Analysts are already calling it a potential AI Minsky moment, a scenario where long periods of prosperity encourage excessive risk-taking until everything collapses. Next, the hedge fund sector. Hedge funds in the UK have borrowed an estimated £100 billion in the gilt repo market, the highest figure since the bank began tracking in 2017. They're using this cash for highly leveraged trades like the cash futures basis trade, which relies on tiny price differences amplified with massive leverage. The problem: a small number of hedge funds control over 90% of this borrowing. Trades are structured with minimal collateral and extremely short maturities, meaning positions must be rolled over constantly. The bank warns that if refinancing dries up, these funds could be forced to deleverage all at once, triggering a cascade of forced selling that could crash the gilt market. We saw this movie in late 2022, when leveraged positions nearly collapsed the UK pension system, requiring the bank to intervene with over £100 billion. And now, less than 3 years later, leveraged positions are larger than ever. The bank's alarm extends to the private credit sector, the so-called shadow banking market. The governor explicitly drew parallels to the 2008 subprime crisis. Private credit, now a $1.7 trillion market, operates largely outside regulatory oversight. Companies unable to secure traditional bank loans are borrowing here, often assuming the economy will keep growing and interest rates will fall. Like subprime mortgages, these loans are often packaged and sold to investors who don't fully grasp the risks. One particularly troubling development is PIK loans, payment in kind loans. Instead of paying cash interest, borrowers add more debt. Essentially, no real money is flowing, just promises stacking up. When defaults hit, there may be nothing left to collect. The emperor, in other words, has no clothes. In public markets, stressed companies' bonds trade lower, making risks visible. In private credit, pricing is opaque, hiding the true scale of the problem. And that's exactly what worries the Bank of England. The takeaway? The bank is sounding multiple alarm bells: stretched equity valuations, debt-fueled AI investments, concentrated tech markets, leveraged hedge funds, and a rapidly growing private credit sector reminiscent of 2008. The message is clear. Financial instability isn't just a possibility, it's coming. The only uncertainty is when. But private credit is even trickier. Assets are marked by the lenders themselves, not a transparent market. Take a recent case. A company was marked at 100 cents on the dollar, and just a month later, it was revised to zero after the company filed for bankruptcy. Its assets were less than $50,000 against liabilities of up to $500 million. How does an asset drop from full value to nothing in a month? In private credit, there are only two prices, face value or nothing. There's no open market to tell you the truth until it's too late. The warning signs are already appearing. Major auto companies have collapsed suddenly. These weren't fringe players, but significant firms, all valued at full price until they weren't. Ratings agencies are now projecting alarming default risks. One recently put the average one-year default probability for US companies at 9.2%, a post-2008 high. Another predicts that defaults on riskier corporate loans could hit 5.5 to 6% in 2025, several times higher than pre-pandemic norms. Major ratings agencies have flagged private credit as showing bubble-like characteristics, financial innovation, growing competition, rising retail participation, and increasing leverage. The Bank of England is so concerned that it plans to run stress tests specifically focused on this shadowy market. But by the time those results are out, it could already be too late, and private credit is just one piece of a larger puzzle. The explosion of non-bank financial institutions, what regulators call market-based finance, has left banks deeply interconnected with hedge funds, pension funds, insurers, and private credit funds. Banks' exposures to these institutions have risen to over 20% of total assets, up from 17% in 2018. Gross exposures to leveraged sectors, including hedge funds, pension funds, and insurers, stood at around £510 billion as of January 2024, or 225% of aggregate bank capital. Everything is connected. Banks lend to hedge funds borrow in the repo market, pension funds invest in private credit funds borrow from banks, money market funds hold short-term corporate paper. Everywhere you look, risk is intertwined, and nobody knows where it's concentrated. The bank notes that, while many exposures are well collateralized, the system's complexity requires robust risk management, the same kind that was supposed to prevent 2008 from happening again. But lessons weren't fully learned. Transparency is still limited, shadow banking remains opaque, and leverage is hard to measure. Simultaneous deleveraging could trigger fire sales and market dysfunction. The Bank of England's Financial Policy Committee acknowledges this openly. They're using stress scenarios to understand how banks and non-bank financial institutions might behave under stress, and whether these behaviors could amplify shocks across the financial system. In other words, years after 2008, the central bank still doesn't fully understand how bad a crisis could become, and that should worry you. Here's how it could unfold. A shock triggers a repricing. Maybe AI stocks collapse, or private credit funds discover their loans are worthless, or US Treasury yields spike, or trade tensions escalate, or commodity prices soar. The initial shock ripples through the system. Hedge funds with leveraged positions in gilts face margin calls. They try to sell, but everyone is selling at once. Prices crash further. Banks begin worrying about exposures to these funds, tightening lending and amplifying the panic. And just like 2008, what starts as a single sector or market could quickly snowball into a systemic crisis, affecting markets, institutions, and everyday investors alike. Lending tightens, funding markets freeze, private credit funds can't refinance their positions and begin marking down assets. Investors want out, but the funds are illiquid. Redemption gates go up, redemptions are suspended. Pension funds holding illiquid private assets face liquidity crunches. We saw this in 2022 with LDI strategies. It could happen again. Credit spreads widen dramatically. Companies planning to refinance suddenly find markets closed. Default rates spike. The private equity industry, which accounts for roughly 15% of UK corporate debt and employs over 2 million people, faces a reckoning. Higher interest rates and uncertainty have already limited funds' ability to exit investments through IPOs, and a credit crunch would make it even worse. Meanwhile, the real economy feels the squeeze. Businesses can't borrow. Investment freezes. Jobs are cut. The recession feeds back into the financial system, causing more defaults, more stress, and broader contagion. The Bank of England calls this scenario simultaneous de-risking by banks and non-banks, leading to fire sales, widening spreads, and tighter financing conditions for households and corporates. In plain language, everything crashes at once. We got a preview in early 2025, when major trade policy announcements triggered sharp market volatility. The bank's report notes that gilt market functioning remained orderly, but contacts suggested that conditions could have become much more strained if the episode had lasted longer. To address these risks, the bank is exploring reforms to strengthen gilt repo market resilience, including expanded central clearing and minimum haircuts for non-centrally cleared transactions. But these reforms take time, and vulnerabilities exist right now. As an open economy with a major financial centre, the UK is particularly exposed to global shocks. We're connected to US markets through banks, hedge funds, and corporate borrowing. If AI stocks crash in America, the shock transmits instantly to London. We're tied to global debt markets. If borrowing costs spike worldwide, UK government bonds are affected. Interest payments rise. Fiscal positions worsen. Through the City of London, the world's second-largest financial centre, many counterparty risks converge. Stress in one market, such as a sharp asset price correction, could spill over into others. Correlations can shift unexpectedly, where assets that usually move independently suddenly move together, catching risk managers off guard. The bank warns that risk models assuming everything is fine could be dangerously wrong. Historical relationships may break down, and when they do, the consequences could be severe. Most market participants aren't prepared. They chase returns in a low volatility environment, assuming the good times will continue, loading up on risk because investors demand it. Sound familiar? It should. This is exactly what happened before every major financial crisis in living memory. We almost crashed in 2022. A controversial government budget announced tens of billions in unfunded tax cuts, and gilt yields spiked at rates not seen since the global financial crisis. The 30-year gilt experienced daily moves 2 to 5 times larger than during COVID-19. Pension funds using leveraged LDI strategies faced margin calls they couldn't meet. They started selling gilts to raise cash, which drove prices down further. More margin calls, more forced selling, a doom loop. The Bank of England had to step in with emergency purchases exceeding £100 billion, becoming literally the buyer of last resort to prevent the pension system from collapsing. Losses from that episode are estimated at more than £500 billion. Some pension schemes lost their entire hedges. Others had to sell assets they had planned to hold for decades. Here's what happened and why it matters for understanding today's risks. For years, UK pension funds relied on liability-driven investment, LDI, strategies. The concept was straightforward: match the duration of your assets to your liabilities. If you owe retirees money in 30 years, buy 30-year bonds. When interest rates move, both assets and liabilities move together. But there was a problem. After the 2008 financial crisis, the Bank of England slashed interest rates and launched quantitative easing. Gilt yields fell to historically low levels. Pension funds that needed 5% returns to meet obligations were earning just 2% from gilts. The solution? Leverage. Funds used derivatives to gain more exposure to gilts than they could afford outright, freeing capital to invest in growth assets like equities and private equity. The leverage was funded through the repo market, requiring regular collateral posting. For years it worked perfectly. Interest rates were stable. Collateral calls were manageable. Pension funds looked like geniuses. Then came the controversial budget. Gilt yields spiked 300 basis points in days. Collateral calls soared. Pension funds realized that selling assets to meet margin calls in a falling market is a recipe for disaster. The Bank of England later described it as a fire sale dynamic that could have caused widespread financial instability. Without intervention, the pension system might have collapsed. UK government borrowing costs could have spiraled, and the economic consequences would have been catastrophic. Here's the frightening part. The bank stopped the immediate crisis, But the underlying vulnerabilities never disappeared. Leverage rebuilt. Risk appetite returned. New bubbles formed. The 2022 LDI crisis was a warning. The financial system didn't learn. It simply went back to doing the same thing, only bigger. Now gilt yields are again near 2022 highs. 10-year yields recently hit 4.93%, the highest since 2008. Experts say another LDI crisis is unlikely because funds now hold more collateral. But unlikely is not the same as impossible, and if yields continue to rise, those collateral buffers will be tested. Let me decode what the Bank of England is really saying in their report. When they say risks to financial stability have increased, they mean the probability of a serious crash is higher than it was 6 months ago. When they say equity valuations appear stretched, particularly for AI-focused tech companies, they mean we're in a bubble. When they warn about the risk of a sharp market correction, they mean they're worried about a crash. When they note hedge fund leverage in gilt repo markets remains elevated, they mean the conditions that nearly crashed us in 2022 are back. When they say alarm bells are ringing about private credit, they mean they see echoes of 2008. When they urge market participants to incorporate stress scenarios into risk management, they mean nobody is actually prepared. When they mention geopolitical tensions, trade fragmentation, and pressures on sovereign debt markets, they mean any of a dozen triggers could spark a crisis. When they highlight that shocks to the global economic or fiscal outlook could be amplified by market-based finance vulnerabilities, they're warning that a small shock could cascade into a major systemic crisis. Central bank language is intentionally boring. It's designed to reassure the public while subtly signaling insiders. They cannot say outright that a crash is coming, because that would trigger panic. But anyone reading between the lines sees the warning. Prepare for the possibility that things could go very wrong. We told you so. That's what people say when things go wrong. But if you read between the lines of the Bank of England's report, the message is unmistakable. They see significant risk of a financial crisis. They don't know exactly when it will happen. They don't know what will trigger it. But they are preparing for the possibility. And that should tell you something. So, when does it happen? Nobody knows. Bubbles can inflate far longer than anyone expects. Markets can remain irrational while you remain solvent. The crash is always coming. Until suddenly, it's here. The conditions are already in place. Leverage is extreme. Valuations are stretched. Interconnections are complex and poorly understood. Regulatory oversight is inadequate. All it takes is a trigger, something that shifts sentiment, something that makes everyone want to sell at once, something that reveals the hidden risks that have been accumulating. And when it starts, the same dynamics that inflated the bubble accelerate the crash. Leverage that boosted returns on the way up amplifies losses on the way down. Interconnections that spread risk across the system spread contagion when that risk crystallizes. The Bank of England stress tests show UK banks could survive a severe downturn without collapsing. That's the reassuring headline. But stress tests don't capture shadow banking. They don't capture the cascade effects of hedge fund deleveraging, private credit unraveling, and pension fund fire sales happening simultaneously. Remember, the 2008 crisis didn't start in traditional banks. It started in subprime mortgages, structured products, and other parts of the system that stress tests weren't designed to capture. If there's a crash, the bank will intervene as it did in 2022. Central banks will provide liquidity. Governments will backstop critical institutions. But the costs will fall on ordinary people. Pension funds will take losses. House prices will fall. Jobs will be cut. The recession will hit hardest those with the least. And once again, we'll ask, why didn't anyone see it coming? Why didn't regulators stop it? Why were banks allowed to take such risks? Why weren't the lessons of 2008 learned? The answers will be the same as always. The risks were hidden in complex structures. Incentives favored short-term profits over long-term stability. Regulators were captured by the industries they were meant to oversee. And everyone was making too much money to stop, until the music stopped and the tide went out, revealing who was swimming naked. So, what can you do? Take the warning seriously. This isn't fear-mongering. This is the central bank signaling, as clearly as it can without causing panic, that risks are elevated. Check your exposure. Look at your pension savings and investments. Are they diversified? Are they concentrated in vulnerable assets? Do you know what your pension is actually invested in? Most people don't. Understand the protection limits. The Financial Services Compensation Scheme protects up to £85,000 per institution. If you have more, spread it around. Make sure your bank is FCA registered. The limit may rise to £110,000 sometime between December 2025 and May 2026, but don't rely on it. Reduce debt. In a crisis, debt becomes far more dangerous. Interest rates can spike, credit can be withdrawn, and what seemed manageable becomes crushing. Variable rate mortgages become time bombs. Hold liquidity. Cash isn't exciting, but it lets you weather a storm without being forced to sell at the worst possible moment. Don't panic. Crises are followed by recoveries. Markets bounce back. Long-term investors who stay the course generally do fine. The worst thing you can do is sell at the bottom. Being prepared is better than being caught by surprise. Understanding the risks is better than being blindsided. None of this guarantees safety. In a true systemic crisis, almost everything falls together. Diversification helps, but nothing is completely safe when the system itself is at risk. The Bank of England is warning us, not with screaming headlines, not with panic-inducing language, but in the careful, measured terms of a financial stability assessment. They're telling us that risks have increased, vulnerabilities are elevated, and the conditions for a serious crisis are in place. Consider the warning signs. AI valuation stretched to dot-com-era levels. £100 billion in leveraged hedge fund positions in the gilt market. A £1.7 trillion private credit boom echoing subprime. Shadow banking connections that nobody fully understands. Geopolitical tensions that could trigger sudden market shocks. Sovereign debt pressures across advanced economies. A global macroeconomic outlook clouded by uncertainty. We've been here before, and we didn't learn the lesson. Now, the Bank of England is signalling, as clearly as central bankers ever do, that we may be about to learn it again. Optimists will argue that the banking system is resilient, that stress tests show banks can survive a severe downturn, and that household and corporate indebtedness is manageable. They're right up to a point. Traditional banks are better capitalized than they were in 2008, and post-crisis reforms did make them safer. But the risks have migrated. They've moved from banks to shadow banks, from regulated institutions to opaque private markets, from visible leverage to hidden leverage, from places regulators can see to places they cannot. When the next crisis hits, it won't come from where we're looking. It will come from where we're not. It always does. The question isn't whether a crash is possible. The bank has told us it is. The question is when, weeks, months, or years, and what will trigger it. AI, private credit, geopolitical shocks, or somewhere nobody is watching? When an institution as conservative, as cautious, and as measured as the Bank of England issues warnings like this, you should pay attention. They're not doing it for fun. They're not chasing headlines or clicks. They're doing it because they're genuinely concerned.